Hello and welcome back to my channel. I am Christy Vann with Fantastic Finances, and on this channel I teach velocity banking. But today we have the Chris NAUGLE with us. I am so excited to have him here again today. We've made a couple of videos together, but I just feel like that the people need to really understand what it means when you talk about becoming your own bank. Chris, I am so excited you're here. Introduce yourself and tell us what we're going to be talking about today.
Oh, thanks so much for having me back on the show. And we're going to be talking about exactly what you mentioned, how people can be their own bank. And it's literally so simple. And I can't understand why more people don't know about it and don't apply this in their life, because it really involves changing one thing and adding one step. And that's what I want to walk them through, is just what that one thing is and that one step and what the benefits would be after that.
How exciting. Okay, so I love infinite banking because I have several policies of my own, and I'm always getting the question, what do you mean when you talk about becoming your own bank? Kind of put that in elementary terms for us.
Yeah, it's simple. And, I do everything with drawing and visual because that's just how my mind works. But it's exactly what everybody's doing today. And if you think about it, when we make money, that money leaves our household to pay for the different things that we buy. Things like cars, houses, boats, everything that you would finance through a bank. That's just what happens. And a lot of people get themselves in trouble. And I mean, you've helped tens of thousands, if not hundreds of thousands of people get out of debt. Well, that's one of the things we want to do, is after they get out of debt or while they're in the process, we want to show them how to not give any more money to the traditional bank. So effectively, what we're going to talk about is a process, not a product. There's no magic thing that's going to just, make somebody become their own bank. It is a process. It requires a little bit of discipline and a little bit of imagination. And that process will enable every single one of your folks to take back the banking functions in their life. Whatever they make, whenever they make a car payment, the car payment will be made to their bank. Whenever they make a credit card payment, that credit card payment will be made to their bank. They will leak no interest to anyone else's bank, and they will keep control of their money. And that's exactly what we're going to do.
I love it. I love it. I'm telling you, there is no more security that I could feel than knowing that I have the infinite policies in place, ready for me to use as I deem necessary. It's a beautiful feeling. But I tell people I started my policies by using my HELOC. And I get a lot of questions about how do you use a HELOC to fund your infinite policies. I believe that you're going to talk about that a little bit today. Am I right?
I certainly can. And actually, the place I wanted to start for your audience is with the home equity lines of credit, the HELOCs, because really what we're doing is we're doing a lot of the same things that you teach every single day. Being your own bank is very much in line with what you teach. It's just, we just got to change a couple of things. And I think that's a great starting place.
Yeah. So the way I worked mine from the very beginning was just to take chunks out of my HELOC and fund my policies. It was really that easy because I already know how to do velocity banking. All I do is transfer my income into the HELOC, let my cash flow stay in there while I am paying out expenses. It is ever so easy. And I'm just going to tell you, and the audience listening out there, the thing that bothered me so much besides my debt was that I had nothing to leave to my children. I had nothing as far as legacy to leave them, no funds, nothing. And when I learned about the infinite policies, I thought, what a great way to, one, not only become my own bank, but two, I am leaving my beneficiaries money tax free. And so that's where you came in, is because you really taught me how to use those infinite policies, how they're funded. I mean, everything. And it all started with my HELOC. That's the only way I was able to do my funding. And I'm excited to share that with everyone. So I want to see how you work that out on your board because you're so good at what you talk about and how all of this process works. And I learn from you every single time we talk. So I'm ready.
All right. Well, I'm going to keep this real simple. And I like to draw everything at a 5th grade level. Is that okay with everybody? Because, hey, that's how my mind works. So we're going to start with exactly what we were just talking about. And what we were just talking about is a home equity line of credit. So let's begin this discussion, this discussion about imagination right there. So HELOC. So what is a HELOC? Well, a HELOC is just your ability to get those lazy dollars that are sitting in the rafters of your house out of your house. That's all it is. It's just going to access the equity of your house. So I'm just going to, or actually, Christy, I don't know, why don't you give me an amount? Like, what would be an average HELOC amount that you'd like me to use?
Well, I have $100,000 HELOC, but my max into any of the infinite policies is 50,000.
So let's just do 100,000. I like that. Nice, easy, round math. So in this example, folks, we're going to assume that somebody's got a HELOC, a home equity line of credit with $100,000. Now, first, before I explain the infinite banking concept, let me just explain how most of you would use a home equity line of credit. So you've got this 100K. So now over on this side, now if I were to draw a line right here, okay, we'll add a little bit of color. Over here are all the things that suck money out of your family. And I'm just going to draw one of them being a car, okay? And actually, I know that is a terrible example of a car. Anyway, there we go. Okay, that's your car right there. So your car, most of you finance your car or lease your car, each of which has a monthly payment. Okay, so whether you are financing or leasing a car, they all come with a monthly payment. So can we just say $500 a month is the payment? And most of those cars are going to have an interest rate associated with them. So we're always going to be giving interest to the bank or the finance company. So let's just use 6%. Okay, I'm just going to use some simple numbers here for today. But the other thing right now that's really hurting families are these things called credit cards. These things are just nasty, and this country has a major credit card issue. So credit cards are accounting for a whole bunch of money leaking people's families. So most credit cards today, and Christy, you probably talk about this all the time, are north of 20% interest. And what a lot of people are doing is they're just making minimum payments, or maybe minimum plus every once in a while they're making a little bit of extra principal. So let's just assume, we'll do some math here. Let's say this is a $25,000 automobile loan, and down here your credit cards, you got $20,000. And actually, let's do 25 just for simple math. That would be 50 grand, $25,000 in credit cards, and you're giving away, that'd probably be what, $500-700 a month, give or take? Easy. $700. So right here, we got $500 leaking for the car, and we got $700 leaking for the credit cards. So what I know a lot of you do is you take the money from the HELOC, you move that money over here, and you pay down the debts. Now, most people would pay the credit cards down first, so let's do that. You take $25,000 from the home equity line of credit, and what we do is we're going to knock out and pay off all these credit cards. Now, if you're smart, what you would do is you would take the $700 payment you were given to the credit cards, and you would pay that back to the home equity line of credit. So now what we're doing is we're recycling and recapturing the $700 we were giving away to the credit cards. We're recycling that back up to the home equity line of credit. Is that pretty fair and accurate?
Yes.
So now let's put some more numbers to this. What would be the average interest rate you're seeing right now on a home equity line of credit?
Right now is about 9.125, and that's for a second position. So yes.
All right, 9.125. Okay, so 9.125. Let me grab just a calculator because we're just gonna do this on the fly because it doesn't really matter. It's not like anything is memorized that I'm doing here today. So 25,000 times 0.09125. That would give you a monthly payment of about $190.10. If I'm doing the math, because simple interest on home equity lines of credit is pretty easy. So you're giving away $190.10 on a $25,000 loan that you take from your home equity line at 9.125. If I did the math correct. So 190.10 is what your cost of capital is. So what we're going to do is we're going to call this cost of capital. Now, you take the $700 and you put that back into the HELOC, you just made yourself a spread because the amount you were giving away to the credit cards was 20+%. I'm just making that number up, but 700 minus 190.10 means that we're just making a nice old spread of 509.90. Not too shabby, right? We're just going to call this spread number 1. All right, so this is pretty cool. Most people get really excited when they can make an extra $509.90. But the problem is we're not paying any of the principal back. So what some people would do is they would take the full $700 and knock the HELOC down, then take the remaining $25,000. So now we're going to do a second, I'll just draw it up here, a second $25,000. So now we've used $50,000 of the 100 and we paid the car off. So then we take the $500 from the car. I'll just do this down here. So now we got $500 going back to the HELOC. That's kind of how a lot of people are using their HELOCs. And I think that's a great use The only problem that we face here is the bank is still winning. I know I tried getting you excited about the spread, but the bank's winning. So now the infinite banking concept is very similar, but imagine a place where you could take the money and move it to it first and then do exactly what I just showed you. So in other words, I'm going to go to another screen. Now we're going to do the same thing we did before. We're going to start with the HELOC. Okay, we got 100K in that HELOC available at 9.125% interest. And then we still, over on this side, we've still got our car and we've still got all those credit cards. Draw these out again because this will be super fun the way we're going to do this. And the car was $500 a month and the credit cards were $700 a month. Okay, so same problem, same situation. We're giving interest away 20%, and we'll just call the car, I don't know, 8, or we'll just call it 9%. We're still giving interest away. So we lose this money every single month. And if we use the home equity, we lose that as well. So now imagine if we took this, now I'm just going to use 50 grand of it, okay? Because I want you to feel nice and comfortable. We just changed where 50,000 of that home equity line goes first, okay? We're going to move it somewhere different. Same scenario as what we did before, except for before we pay the debts off, we're going to take that 50,000, and I know this is going to surprise some of you, but we're going to move it into a whole life insurance policy from a mutually owned life insurance company that pays dividends. But now let me add one. Well, before I say anything, if I just paused, everybody's like, their jaw drops. They're like, no freaking way. That's the worst place, says Dave Ramsey, Susie Orman, and so many others. Why would I ever put money in a stupid whole life insurance policy? Well, if I were to take that whole life insurance policy and I were to design it, so I'm going to put SD, which stands for specially designed, and I were to design it so that you had the highest immediate cash value possible, now it would become a really cool place to put your money. Because let's just talk about not what it is, but let's just talk about why we would use a specially designed whole life from a mutually owned company that pays dividends. First off, they pay a guaranteed interest rate. That guaranteed interest rate, so let's just start over here. I'm going to just draw these out. Okay, guaranteed interest. Not just for a month, 2 months like a bank, or not 6 months to a year like a CD, for the rest of your life. Contractually guaranteed. And the insurance companies we use, it's anywhere between 2 and 3.25, of which the company we mostly use is 3.25. So we'll just say that. I just want to put that up there for disclosure. 3.25% guaranteed the rest of your life. But wait, there's more. The insurance companies, because they are mutually owned, they love the policyholders and they share with the policyholders in the form of a dividend. So if we take the guaranteed interest plus the dividend, although dividends are not guaranteed, they have never missed one in all the years they've been around, and they've been around for well over 100 years, never once missed a dividend. So if we take the guaranteed interest plus the dividend, that gets our rate upward of 5 to 6%, depending on the insurance company. So now, just by changing where the money goes first, we have a way where we can earn 5 to 6% on our money every single year. That money grows tax-free because we design them properly. That money isn't just tax-free, it's also protected. So if somebody trips and falls on one of your properties, it is protected against judgments and liens in almost every state. And we could give you a list of the states and how they're, but not only that, it provides a death benefit, which you already knew that because that's the thing that everybody says is terrible. Buy term and invest the difference, they say, but we want a death benefit no matter when we die, not just during a period of time. So all these things are the reasons why we would use a whole life. But the reasons we wouldn't want to use a whole life, and the reasons that they always say, is that you put money in here and you don't have access to that money for 1 year, 2 years, 3 years. But yes, we're designing it so that you have immediate access to your money in the first 30 days. So now let's play that same strategy out now that you understand why we use the whole life and you understand that it is designed and engineered to give you high, immediate cash value and liquidity of your money in the first 30 days. So what we do now, we put 50 grand into the whole life. Now, when we do this, we can't just put money in one time. But if we did 50 grand, we would probably do something like 50 as a dump in. I'm just going to talk a little bit about the design. Okay, we dump in 50 grand. Think of it like I have money in my right pocket, which is the bank. where it's not earning a lot, and we're going to take it out of my right pocket, we're going to put it in my left. Or in this scenario, we're going to take 50 grand from the HELOC and we're going to put it in our right pocket, or sorry, our left pocket, where it's going to pay us more than a bank account would. Fair enough? Okay. So now we got 50 grand in there, but now to build this and make this work, it can't just be $50,000. You got to make deposits every single year. But in this case, let's just say we did deposits of $500 a month. We can change this and build this any way you want, but for a $50,000 dump in, that would be pretty close to the minimum you could put in. So now each month we're going to save $50 or $500 into that policy. If we built it like this, I can tell you one thing, that would be incredibly efficient. You would have access to a lot of that money in the first 30 days. How much? Well, let's just come over here and look at our debts. Remember, we had $25,000 in credit card debt and $25,000 in a car loan. So what we would do with this design, we would immediately go in and we would take a loan. Now, I know some of you are like, why would I take a loan from a loan from a loan? I don't want another loan. I'm trying to get out of these loans. I get it. Stay with me. We're going to take a loan and we're going to pay off those credit cards just like we did before. So we took a $25,000 loan from the policy. Remember, before we did it from the HELOC, but now we're doing it from the policy and we pay off the credit cards. We then do the same thing we did with the HELOC. We take the $700 and we're going to put the $700 back into the policy. Every single month, the policy is now getting $700 a month back into it. And immediately, very shortly thereafter, we're going to take another $25,000 out, and we're going to do the same thing we did before. We're going to pay off the car loan, and then we're going to recapture the $500 every single month. So we did the same thing we did before, but why did we take a loan from the insurance company? Well, here's the reason why. When we put 50 grand into the whole life, that 50 grand was earning interest and dividends. But when we took the 25,000 out for the credit cards, the 25,000 out for the car, we still want to earn interest and dividends uninterrupted. So we want compounding interest, but we want it to be uninterrupted. So to do that, we don't want to take our 50 grand. We want to use the insurance company's 50 grand. Now, remember I said the insurance company promised you a death benefit someday when you die, but you don't plan on dying anytime soon, I hope. So why don't we just use some of the death benefit money while we're alive? The insurance company will allow you to take loans, and when you do, they're going to subtract those loans from the death benefit. So if you were to die too soon, you took that loan and you died after you took the loan, the insurance company is going to pay the death benefit to your family minus the outstanding loan. And by doing this, what they're then going to do is they're going to take your $50,000 that's in cash value, because remember I said you just took it from your right pocket and put it in your left. They're going to still pay you interest and dividends on that, but they're also going to use that to collateralize these two loans. It's brilliant, folks. The insurance company takes really no risk because it's collateralized against the money that you have in the policy, but you stand to benefit because now you got $50,000 earning interest in dividends while the money's paying off these two loans that you were losing the money. Okay, that money was leaving your family forever, and now that money isn't leaving your family because now that money is back in the policy. You see, whether it was the HELOC or the specially designed whole life, when you paid the HELOC back or paid the whole life back, the amount you were giving away, you now control that money. You have access to that money. You have full liquidity. You've plugged the holes in your proverbial boat, okay? Your boat isn't sinking anymore. Your boat is actually floating, and floating much more efficiently because all the money's here while your money's still earning interest. So then there's the other question of, okay, now we took 50 grand from the HELOC. How is that 50 grand going to get paid back? Well, we could easily just take the money from here, pay it back up, or we could just take money that we normally would save and pay just the interest on that, because it doesn't matter. We're taking all the money back and we will be able to pay the HELOC off. Let me pause. Christy, any questions on that? Because I got a really cool thing that we did as an example, and we did all the math for a 2-day training we just finished up that I'd like to show, which is the same thing as this.
Okay, no, I don't have any questions, but you know, when they use velocity banking to pay back that HELOC while they're using the whole life to pay their debts off, I mean, that 9.125 won't even apply.
No, this won't even matter because remember, we were giving
Right.
away 20% over here and 9% here. So if you blend that out, it's way more. So
Yes.
here, now we get to make the spread there. So if we were to just do it the same way, remember I said that's the spread, 20 minus the 9.125. But you see, now you make money twice because now you got two spreads. Over here, you've got your policy earning interest and dividends at a rate higher than what they're charging you. Because remember, I said that loan they're going to charge you is roughly 5%. I'm going to cover this more in the next slide, but I just want to kind of lay it out that it's almost the same thing most people are doing today, except for you're taking back control of all the money. And you're taking back control through a non-conventional vehicle that's been around for hundreds of years called a whole life insurance policy that we design and engineer contractually so that it works and has more liquidity in those early days. So that's all we're doing.
And I mean, that's great. I love it. I love to hear you talk. I love it because you're so good at what you do that it makes it so simple so that somebody like me that doesn't really have time to think about it. I mean, I want to start another one today.
You want to start another one today. I love that. So let's just go to one more example. Let's just assume that you did that strategy we just showed. And now you have no debt. So now you're thinking, okay, what's next? Now my debts are mostly paid off, or at least I'm comfortable with my debts. I want to make my money go to work for me. So let's go back to that same scenario. You've got a home equity. Now the numbers are going to be different here because this is an example I trained on this past weekend, but we're going to use the same $100,000 HELOC, but now we're going to use an 8% interest rate. And the only reason I'm using 8 on this one is because this is already the math I did. We got 8%. So if we were to use that $100,000 in that HELOC at 8%, the cost of capital, so every time you see COC, its cost of capital is $667, okay? That's how much a month it would cost to use that $100,000. Now, if you were gonna take money from a HELOC and go out there and start, we'll just use private lending, because right now, there's a lot of places you can invest money, but I would warn all of you that where we're at in the economy, where we're at in the stock market is that tippity top. We're off the top a little bit now, but the only place it's going, if any of you are wondering, is down, okay? At least for a little while, because we're at the end of a cycle. So if the markets are going down, you got to be really careful investing money in the stock market. Sure, some of you would say, well, if I invest now and it's going down, I'd be buying low. And if that's great, do that. But let's just talk about another strategy, a strategy that all the wealthy folks I've ever come in contact with do, and some of the wealthiest families throughout history have made a little fortune doing what we're going to talk about. And what we're going to talk about is private lending. You becoming your own bank, but you becoming your own bank by lending money the same way a bank does. So just think about the house that you bought, okay? That house that provided you the ability to get the HELOC. Eventually, or sometime in the past, you bought a house, you went to a bank, got a mortgage, and then you made monthly payments to that bank for that mortgage. But the bank, before they made that mortgage, before they gave you that mortgage to buy the house, they took collateral, did they not? Even the HELOC, Christy, you had mentioned second position, but your house probably had a mortgage, or maybe even still does, in a first position. So one of the most important things I want to talk about is protection of your money. Banks love low risk, and low risk means they are numero uno. You don't pay them, there's no one else to answer to besides the bank, and the bank can foreclose and take that house. You need to be just like a bank. Think like a bank and be the bank. So here, we're going to take 100 grand from the HELOC. And hypothetically, we're going to put it into one of those specially designed whole life insurance policies. And when we put it in there, remember I said you can't just put money in once. So doing this would require about $1,000 a month savings into that whole life. I'm just setting the precedence so you understand. It doesn't have to be this way. You could design the policy any way you want. I'm just using this as an example. So you got $112,000 after the first year in the policy, and roughly about a $700,000 death benefit. So what we're going to do is we're going to go on to a site, which I'm going to do another video to talk about this, called privatemoneyclub.com. It is literally like a dating site for money. People with money you in this scenario, meet people that need money for the real estate deals. And then you just meet together. It's a totally free platform. You don't have to pay anything to become a member of Private Money Club. There are ways you can get better at it and do more with it. But for today, you just go on it and you just want to see what's on there. Now, here, let me flash over here real quick, Christy. I'm going to share my screen and I just want to show you something here because I pulled this up today and this was kind of just perfect timing for what we're talking about. And here it is. This is Private Money Club. And I went in here and I went into the deals page, which is right there. So I just clicked deals page. And the very first deal that popped up, so we're just going to use this, and this wasn't planned. Well, actually, second deal that popped up because a new one just went up, is this guy right here. 15% interest, okay, ROI, on a rehab deal in first lien position. Now, I don't know whether this deal is good, bad, or indifferent, and that's not the point. I'm just showing you that this is just one deal of tons of deals on here, and we could find here's another 15%, there's a 12%. We could just keep going all day long looking at deals, but let's just focus on this one here, 15% interest. So I'm going to use that as an example for this scenario. You put 100 grand into the whole life, and that money came from the HELOC, which now has a cost of $667. Plus, you're putting $1,000 into the whole life for your premium deposits. So what we're going to do is immediately, as soon as we put the money in, we're going to take a loan. And I'm just going to use 106,000 because you wouldn't be able to take all 112,000 out immediately because you can't take it all, but you can take a high percentage. So let's just call it 106. If we took a $106,000 loan from the whole life, they're going to charge us interest at 5%. This is the part nobody likes. But remember, they're paying you interest and dividends on the full 112. You're still earning on $112,000 when you took 106 out that you're going to lend on that real estate deal, and they're going to charge you interest on that. So you're making more than what you're paying in most scenarios. So now you got 106,000. We lend that money out here. So I did the math at 15% in a first lien position, that's $1,250. $1,250 is how much money we are going to make on that first lien position deal at 15%, okay? So now let's just figure out two things. If we know we're making $1,250, how much did it cost us for the capital to use from the HELOC and the whole life? Well, the HELOC was at 8%. And the best part about looking at HELOCs today is come September, the Fed is more than likely going to drop rates. Now, folks, if you're watching this after September, this is September 2024. We're at this part right now where the Fed is talking about decreasing interest rates. So if 8% is where we're at today, chances are in the future it's going to be a little bit lower, just putting it into perspective. But we're going to use the high 8%. That's $667 a month, and borrowing it from the insurance company so that we can have our full money earning interest is 5%, cost of capital is $441. So our total cost of capital is $1,108 in this scenario, which in this scenario, you have a chance of this making you even more money because if rates go down in your HELOC, you're now making more money. And as your money compounds, which it will every day inside of a whole life, you have more money than you did the day before because it's guaranteed interest. Now, all of a sudden, you're going to make more in the future. But let's just talk about today. We make $1,250. It costs us $1,108 to use the money. What did we do? Well, we made a spread. And how do banks make money? The same exact way. They make a spread. They pay you a certain interest rate to give you their money, and they charge you a certain interest rate to borrow the money. And in the middle is the spread. We're doing the same thing. So now here with this exact scenario, using the equity in your house, putting it into a whole life, lending it on a real estate deal in a first lien position, we make $142 every single month. Plus the amount that your $112,000 is earning inside of the whole life, plus the potential for you to make even more if rates were to go down on that HELOC. But nonetheless, what did you gain here? You could have just lent direct from the HELOC. And some would have said, oh, I would have just done that. But you would have given up the ability for your family to have a death benefit protection in this example of roughly about $700,000. $700,000 of death benefit for the rest of your life that will go up in the future, a cash value that is growing uninterrupted every single year over and over again. So nothing can ever happen except for you make more. And now a spread, 142. I know some of you aren't getting excited about making $142, but listen, As you keep doing this over and over, you keep making more and more. But right now, you don't have that 142 coming in your household. Now you do. So folks, this is just another example of being your own bank. So we took you through using it to pay off debt. And now this is actually the fun part when you start using it to be the bank and lend money.
That is so exciting to me because I'm tired of throwing away my money. I work with people every single day, and I'm not talking about $200 or $300 a month. I'm not talking about $667 a month that they're throwing away in interest. They are throwing upwards of $3,000 plus away on interest right now, interest only. And everybody is hurting. Everybody is suffocating under debt because they are paycheck to paycheck. And in your scenario there, when we were talking about the HELOC, when you're paycheck to paycheck, who can afford to think even about funding any kind of investments or, infinite policies? When you're using that HELOC, just like you showed there, it's giving people to, one, protect their families in the event and when they pass away. But two, it's giving you access to become your own bank because you don't have to stay in debt. When you're funding these policies, and you can pull right back out and pay off your debt, and eventually you won't have any debt. So now guess what? You get to make more infinite policies. I mean, it's a beautiful cycle, and I love it. You said a lot in there. It's a lot for people to comprehend, exactly how this works. But that is a great example of how you can make your money work for you.
100%. Well, there's a lot more, but I just want to kind of start somewhere. And this was the starting place, paying off debts, using the HELOC, and then having some fun through Private Money Club.
Well, I appreciate you so much for coming on today, Chris, and sharing with us. I know that you're the best of the best, and that's why I love that you have chosen to join me on my channel to explain to my audience just how wonderful it is to be in control of your money. I appreciate you so much. I look forward to working with you in the future. Thank you so much. And let's do another video on the Private Money Club and really get in deep about how that can absolutely help people with their future.
That sounds great.
All right. Thank you guys for joining me today. I have just so enjoyed this conversation. I would not send you to anything that I am not doing myself. Chris NAUGLE is my personal representative when it comes to these infinite policies. His team is excellent on what they do. They follow R. Nelson Nash's book to the T. If you've not read R. Nelson Nash's book, Be Your Own Bank, please check that out. You're going to love it, and I look forward to having him back here soon. But please stay tuned because we are going to have upcoming videos on the Private Money Club for you guys who are interested in that. Thank you so much for joining me today, and I look forward to seeing you in the next video.